The issue is that in getting wrapped up in this controversy over whole life insurance completely blinds us to the true problem that we face. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today we're going to be discussing the controversy over whole life insurance and how we arrive at also discussing the infinite banking concept as conceived and described in R. Nelson Nash's book, Becoming Your Own Banker. Welcome to the show. Let's begin by discussing something that is widely heard in the financial entertainment world, which is, well, at face value, why would I pay higher premiums for whole life insurance when I could be paying a mere fraction by buying term life insurance? And at face value, with no other inputs, of course, naturally we could see a higher price here and a lower price there, and they're both for insurance. And we would say, well, obviously I want the lower price. And if that's the only factor, which it's not, and I would suggest that it shouldn't be, then naturally we would acclimate to getting the lower priced item that's going to provide the same amount of face value or death benefit. But that's not the case. Now, let me then, we're going to have to talk about this. Whole life insurance has lots of characteristics that term does not. Term is very simple. You will pay a set, consistent amount of premiums over the duration of the term that such a policy is in force. So there will only be a payout of that death benefit if you graduate, if you pass on during that term. And those premiums will be set over it. Now, if you want to get insurance after that term has expired, then you're going to have to reapply. And of course, obviously, over the course of time, with us getting older and perhaps health is changing and whatnot, then who knows? I don't know what tomorrow holds. You don't know what tomorrow holds in that regard. And term insurance has a place. And I'm not saying get whole life insurance, get term. I am going to be educating on here and what I do believe, obviously, for anyone that's listened for some amount of time. But for the newcomers, those that are vetting this idea of why own whole life insurance, why study and vet and implement this infinite banking concept, whole life insurance is insurance that is permanently owned. So there are some upfront things to consider. You would go through a full underwriting, which means that you're going to give samples. You'll give a blood sample. You'll give a urine sample. The insurance company is, of course, going to evaluate smoking, non-smoking, what's your age. You can only apply for a certain amount of death benefit, and that's going to be based off of, mostly a couple of variables concerning your health, age, and gross income or replacement of net worth, let's say. So you're going to go through a full underwriting, and that means that, a nurse is coming out to your house and collecting those samples, and you're having some phone calls, and you're answering some emails, filling out an application, of course. So there is more upfront than there is necessary for term insurance. It's very simple. It's very straightforward. They're just going to be evaluating you to know what to offer you in a whole life policy. Now, simply concerning whole life insurance, there are several, more than a dozen, characteristics that I would describe a properly structured whole life policy with a mutual company as having as the most appropriate, the most advantageous appreciating asset that I'm aware of in and of itself. Before we even begin to discuss how to use such a policy for the banking purpose, for privatizing our banking, such a policy is going to be a private asset. It's going to allow the owner to have control, to have the right to amass capital, and also to access that capital and also to have that capital growing, compounded, uninterrupted. It's going to allow that capital to grow with lots of tax advantages. And some of those are going to be absolutely tax free. Some of those may be tax deferred. You can make withdrawals from that amount. That's not my suggestion, of course, because that would interrupt the compounding that I've already mentioned. But you can also leverage the cash value of a policy that you own. And there are several other characteristics. It's a hedge against inflation. It's a hedge against litigation. There are so many things, but let me mention here, because I begin to talk about cash values. And again, that's another point where folks will jump in and say, why would I pay interest to use my money? That's their wording, not mine. And you can hear that kind of wording in several different places. So I'm not trying to bash on anybody. What I suppose is that when someone says something like that, they're just ignorant to certain facts, perhaps. Just simply meaning they don't know. That's fine. That's great. I did not know lots of things about whole life insurance, even though I had owned some life insurance. I'd bought some life insurance. I believe I'd had some term and some whole. I was just doing the conventional thing, paying into 401ks, and I had a state retirement, and I wanted to have insurance on my cars and home, and then on my family as well. So I had insurance. But folks will say, well, why would I put my money somewhere where it's not growing, or maybe it grows 1%? Again, that's what they're saying. And then if I want to use some of my money, then I'm going to have to pay the insurance company interest to be able to use my money. And I suppose, again, that folks, when they say that, they're just ignorant to the fact of what actually is taking place. That's me assuming that there's no malintent. Okay. So, and if there is, well, that's a different discussion. But what's happening is, and what I promote is not taking withdrawals from the capital that you've accumulated in a policy that you own. Rather, leverage that capital, leverage that cash value via a policy loan from that insurance company. And there are lots of beautiful things that make this an advantageous use of those cash values. One is you're actually getting a policy loan from the company's general account. That policy, it's not like a safety deposit box where you're putting something in. It's not being touched. Money has to be in motion, and we'll get to that in a second. But the insurance company is giving us a loan from their general fund. So our cash values, the capital in our policy, continues to grow, compounded, uninterrupted, even though we have a contractual right as the owner of that policy and as a part owner of that company, because if you own a policy with a mutual company, you're part owner of that company. We have a contractual right to access capital in a known interest environment. So let me also say something else about myself. I've taken personal loans from commercial banks before, and I don't want to get bogged down in the numbers, but suffice it to say, the money that I had borrowed conventionally from those banks was at a significantly higher interest rate. Meaning I was paying more interest to be able to do that, again, on the bank's terms and conditions, paying interest there at a multiple of what I could have leveraged capital in a policy that I owned and controlled to be able to access capital for the same things that I would have wanted to do otherwise. So suffice it to say that you can leverage capital in a known interest environment, and surely it can be done so at rates much more advantageous to the borrower than what a commercial bank would give you. So folks are saying, well, why would I pay interest to borrow money? So you're not borrowing your money. You're borrowing the insurance company's money. That's why there's interest. Where else can you borrow money without paying interest? Now, again, this is us getting beyond just comparing, let's say, well, do I get term insurance or do I get whole life insurance? Because we're beginning to talk about, well, we can begin to talk about banking. Really, I mean, what I'm describing here, being able to access capital because you privately have cash values because you're the owner of a policy, that's something that our grandparents have done over time. I mean, really, if you look in history, and I don't want to get my cart before my horse here because I know I have these notes written down, but if you look in history at folks that didn't know the terminology and had not been exposed to the scale that Nash, see, that's Nash's contribution, his self-acclaimed contribution to borrowing against cash values from whole life insurance policies, is that he provided scale. See, it's called the infinite banking concept. That's what Nash did. And I'm so grateful, because over the course of time, we've seen folks like Walt Disney, J.C. Penney, the owner of Pampered Chef, the owner of Foster Farms. We've seen Stanford University. We've seen lots of different entities, and I'll get to some more here in a minute, I believe. We've seen lots of different entities that have either used their cash values from whole life policies, just standard, not structured for the banking purpose, just standard whole life insurance, use their cash values to build Disneyland or whatever the case happens to be. And then, of course, we could also, of course, talk about death benefits because folks had permanent life insurance. They just didn't have insurance for 10 years, 20 years, 30 years, but they had procured permanent whole life insurance. And it's called whole life insurance because it's for your whole life. So because these folks had permanent whole life insurance, they knew that they would be contributing a certain amount of a tax-free transfer of wealth to their beneficiaries or to their heirs because they had this whole life insurance in force throughout their whole life until their graduation, until their passing. So then there was that tax-free transfer of wealth because a death benefit is 100% tax-free. So there are many characteristics that make a whole life insurance policy at face value. Again, here's what I'm trying to present at this moment. Term life insurance is paying a fraction of what you would pay for whole life insurance to have that what if money come to your family or come to your beneficiaries or your heirs in the event that you graduate in a span of 10 years or 20 years or 30 years or however long that term is. Whereas whole life insurance is guaranteeing you that eventually that policy will mature either at age 121, if we're talking about a whole life insurance policy for 121 years, or upon your passing, upon your graduation, that policy will pay out. So if the face value were equal at the onset, let's say $500,000 was going to go to the beneficiaries of the term policy holder's family. And the same number, $500,000, again, I'm just picking a number, $500,000 is going to go no matter when that graduation, no matter when that death takes place. That amount as well is going to go to that insured's family or heirs or beneficiaries. Now, even at face value, there are several differences. Again, the term is only for a term. Now, if that's standard, even if it's just plain Jane, vanilla, straightforward, standard whole life insurance is with a mutual company that pays dividends, well, if we start out at $500,000, that's not where we're going to end up. See, the term insurance is going to be the same over those 10 years, 20 years, 30 years. It's going to be that $500,000. And I know that this is non-guaranteed, and I'm going to tell you that. However, these mutual life insurance companies pay dividends. And there are many that have done so for well over, hear me on this, 100 years. Now just think about what's happened in history over the past 100 years. Our country has experienced dot-com bubbles, real estate busts, stock market crashes, Great Depressions, global conflicts, world wars. I mean, the list goes on and on and on. Pandemics. And I'm not talking about anything recent. All these different historical events, and these insurance companies have paid dividends every single year consecutively for well over the past 100 years. Okay, so what that means is that when a company pays a dividend, you can do what you want with that dividend. You can just take that as a check. They'll just send you the check. You can do several things. What I promote is that you take that dividend and buy paid up additional insurance. Now, what that means is that you can see that face value increase, that face amount, the death benefit of the whole life policy increase. So after that same time passes in comparison with a term insurance policy, that $500 million, well, it can't go down. It can't go down if we're not accessing cash values. It cannot go down. And even though a dividend is not guaranteed, once you have been given a dividend, it can't be taken away. And it will forever add to the efficiency and the growth of that policy, both in its cash values and in its death benefit. Because the cash value is just a net representation today of that future death benefit. So, and again, I'm not trying to pin down any numbers, but that $500,000 can grow to 501, 505, 510, and on. And of course, that's going to depend on different variables, and it's not guaranteed. But again, if these insurance companies have been able, in their conservative business model, to provide a dividend for well over the past 100 years, we stand a very likely and probable opportunity to earn dividends in the future as well. And all that is going to do is to compound and to grow and to continue on. So what I'm saying is at face value, there are so many variables that on price point, let me come back to that, on price point, naturally, if term is only providing a set amount of premium, a minimal set amount of premium for a very specific, not to grow amount of death benefit and only for a certain term, that's going to have a particular cost to it. Whatever it may be, that's going to be a particular cost. And that is not, we are not comparing apples to apples here. This would be apples and oranges. There are so many different characteristics that even at price point make it reasonable, logical, practical for whole life insurance to have a different price to it, aside from how it's structured for the banking purpose. And there are going to be some other differences between these two. Another way to look at term insurance, coming down to cost, so to speak, is that every dollar that is paid for coverage, term coverage, it's going to be pure expense, meaning there's no access to capital there because there's no capital amassing from those premiums. So over the 10 years, the 20 years, and the 30 years, there's not going to be any return of premium. Whereas with a whole life insurance policy from day one, that policy has a cash value. It has a cash value, which is simply a net representation today of that future death benefit. And I know that here, this is where those financial gurus are going to jump in and say, well, we know it's going to be pure expense. That's not the point. We're just trying to get insurance here. We're not trying to build an investment. We're not trying to build a savings account. We'll do that elsewhere. We'll be paying into our qualified plans for our retirement. We'll be paying into our 401ks. We will be setting aside, our 3 to 6 months of expenses or a savings account or an emergency account elsewhere and, some other location. Well, again, that's just the difference between those two. Pure expense for term, and maybe other things are being done with the difference, and we'll get to that because that's the overarching theme is, well, buy term insurance and invest the difference that you otherwise would have paid into whole life insurance. And that, in my mind, is the proverbial, looking over the dime to get to the penny. The penny's bigger, it's got a different color to it, it catches your attention, and you're overlooking the dime. Well, what's that saying? Oh, it's about nickels and dimes. Regardless, That's what's happening with term insurance. It's pure expense for a set amount of coverage for a set term. Whereas with whole life insurance, obviously the cost is going to be greater because you're buying longevity. You're buying the contractual right to have permanent coverage, to have perpetual access to capital over your lifetime. And then, of course, eventually what's going to be a tax-free transfer of wealth. Now, let me jump in here. We've talked about the price difference between these two types of insurance. We've talked about, well, do you or do you not pay interest to an insurance company to borrow your own money? You don't. And really, when you wrap your mind around what the infinite banking concept is all about, interest that is paid to a company that you are part owner of, that you receive dividends from, and that you have a private and a contractual relationship with. Do you or do you not want that company to be profitable? Absolutely. Absolutely. Now let's get to that payout, because there are lots of folks who will speak adamantly about, well, yeah, but even if you keep it, even if that's what you want, you got to know that they're robbing you. They're only going to pay you the face amount. That cash value that you talk about, that cash value that you're mentioning, they're going to keep that part. They're not even going to give it to you. And again, here, what I believe, what I prefer to believe is that these folks are just not aware of what those numbers represent. They're ignorant to it. They don't know. And again, that's fine. There was a time before 2015 that I had not read Nash's book, that I had not made a deep dive study into whole life insurance and what this infinite banking concept is all about. And that's fine. Everybody has an opportunity to be able to continue to learn and read and to grow. But what I'll do is I'll describe it. So again, I've already said it a couple of times. A cash value is a net representation today of a future death benefit. A cash value, when a company tells you that you have this amount of cash value, what they're saying is if you surrendered this policy, if for whatever reason you decided to quit, you decided to surrender all the contractual rights of this unilateral contract, there would be an amount of money that you would be paid to surrender that. Because again, the insurance company is contractually obligated to perform for the rest of the lifetime of that policy until its maturation. All of the terms in that contract, all of the guaranteed access to capital at a certain interest rate, the death benefit, the opportunity to earn dividends, all those different things. They're willing to pay you if you're willing to cut that contract short. If you choose to cut that contract short, they will pay you what is contractually due to you. Now, knowing that the cash value is a net representation today of a future death benefit, let's just pick another real world example to make a comparison, to let this relationship of these two numbers sink in. Because yes, an insurance company is only going to pay you the face amount. And here's the real world example. A home. Let's say you've bought a home. Let's say you've even made improvements, renovations, maybe an addition, maybe the market's gone up. You've had this for a certain amount of time and you've been amortizing what you originally owed on this. And let's say the value on that home has gone up. There's a certain amount of equity that you've obviously built in that home. And if it's valued at a certain amount and you decide, yep, I want to be able to sell this, we're going to get something different, we're going to go somewhere else, whatever the case may be, when that home is sold, you're only going to get that sale price. You're not going to walk away from that transaction asking the bank or whomever, well, hey, yeah, you gave me the sale price, but I want the equity as well. You don't get to sell the home and get the equity. The sale price of the home is all inclusive. It's all inclusive. Are you following me? And I find that very interesting because folks who will speak so loudly about, well, the insurance company is just going to keep your cash value, they do things in real estate. So it's really interesting, and I hope you're following with me here. The company's not going to give you a cash value, which is a net representation today, and the death benefit amount upon your graduation, upon your death, upon your passing. Because the cash value was just a representation of a prior time to that future guaranteed death benefit. Just like a house may have a certain amount of equity right now, and maybe you leverage that with a commercial bank. Maybe you get a home equity line of credit, a HELOC, or what have you. But if you decide to sell that home, it doesn't mean that you're going to get the sale price of that home and the equity. The equity was just a representation of that overall value. And if it's sold, well, then that's the amount. Just like when you pass, when you graduate, if you have permanent whole life insurance in force, that's going to be a tax-free transfer of wealth. That's going to be a payout that is it. That's the resolution of that unilateral contract that you had with the whole life insurance company. So that's one big thing that folks like to speak adamantly about, to disregard, or even to downplay, a very serious advantage to whole life insurance. And that is that there is permanent coverage, and there's also permanent access to capital because it has a cash value, that policy. Now, I'm actually going to read this off because I wrote down so many notes about the advantages of a whole life insurance policy. You get longevity with a whole life policy. You do get a return of premium because as you're paying premium dollars, you're growing a cash value that you have access to. Access to capital is the next thing. Tax benefits, the permanence. I mean, what kind of price point can you put on the permanence, the peace of mind that a whole life insurance policy can provide? Who knows how our investing may go in the future? Who knows? So again, if we can use depreciating dollars, that's its own discussion. But if we can use depreciating dollars to own an appreciating asset, that's a beautiful relationship. Net worth, liquidity, known versus unknown interest environments into the future. I don't know what the interest environment is. We can see that there seems to be this boom bust cycle that takes place. But again, I don't know what the interest rate's going to be like in the future. How about the flexibility of how much premiums to pay? This is something that, with proper structure, it doesn't necessarily come into the conversation. Folks will just say, well, term is, 1/20th or 1/5, or they'll throw out some number of the cost of whole life insurance. Well, I've never heard anyone speak about the flexibility of premiums of a whole life policy, because there is lots of flexibility as the owner of a properly structured whole life policy with a mutual company when it comes to paying premiums. Perhaps there's a dry season or a rough time in your career or in your business, and perhaps you just could be paying a minimum amount of premiums to keep a policy in force and still maintain all of the control and the access that you have as the owner because you keep the policy in force, but perhaps it's not funded to its absolute potential. Perhaps you have the contractual right to pay more premiums than you do, but you pay what you need to keep things in force at the time. And again, you can do that while leveraging the capital that's in the policy also at the same time. So and you can use the capital in a policy to self-fund. So there's so many things. There's a lot of flexibility owning a properly structured whole life insurance policy. Again, the peace of mind guarantees. Where else in the financial world do we get to use and hear and enjoy the words guarantees so much? What are the guarantees with your 401k? That it won't go below zero? Well, that's not very encouraging. What are the guarantees with your investing for all these folks that want to say, well, the market does 12%. It does nothing but go up. You should have put that difference into X, Y, or Z. And again, I'm not saying don't do that. If you want to put your capital somewhere, if you want to make an investment somewhere, do it. What I ultimately ask is, who controls the banking function in your life? Who controls the banking function for those investments that you want to make? Whatever they may be. The 401ks, the IRAs, the 529s, stocks, bonds, mutual funds, real estate, precious metals, commodities, whatever the case may be. Your own business, if you're a business owner, that makes sense, right? Reinvesting back into your business. Regardless of where you want to invest, who controls the financing of that business or that investment? Who controls the banking function as it relates to your need of finance? Guarantees. Compound interest. Folks like to talk about compound interest. Einstein said that those who understand it earn it, and those who don't pay it. He called it the eighth wonder of the world. I actually recently did an episode only on compound interest. I'll have to put something in the notes perhaps here about that. I found it very interesting. I thought it was really good. That's self-promoting, I suppose, but you'll let me know in the comments or our phone calls. Exposure to the market and the volatility. How about that characteristic? How exposed do we want to be to a volatile market? Again, that's your choice. I'm not saying one way or the other, but consider this. What if you accounted for your need of finance for an investment that you want to make in the market, and you could leverage an appreciating asset that does have compound interest, that does have guaranteed growth, and you leverage that to do the investing that you want that is exposed to the volatility of the market? Maybe it goes up, maybe it goes down. And you could keep both. So if you do well in your investment, we've got an appreciating asset that you leverage and that you get to keep even though that investment did well. You have both. Okay. And again, let's say that investment does poorly, but you initiated that investment with capital from a leveraged appreciating asset that you maintain. Well, that's what I would, assume is not a total loss. So you're better off either way, not ignoring the fact that someone controls the banking function in your life. I promote the idea that it should be you for you and me for me. It's transferable. I can't transfer term insurance to someone else. You can transfer whole life insurance. You maintain a lot of control, obviously. It's a reputable. Again, these are companies that have not only been around, they've been profitable. They've been paying dividends for well over 100 years. Reputable. It's private. There are no hidden fees or penalties. And again, when folks say, I'm getting into so much here, but when folks say, buy term and invest the difference, keep reading, keep listening, keep learning. Don't let that arrival syndrome get you. Keep studying. And if you'd like to have a conversation about how you can implement the infinite banking concept into your household or your investing or your business, then you can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. It's been a great pleasure for me. I look forward to our next conversation. Have a great day. Take care. Come on now, Trigger. Put that pea shooter down. ¡Oh, yeah! Mira, la cosa es esta. Que tú y yo necesitamos hablar, ¿vale? Pues, I feel like a champ. I feel like an absolute champ. Why, Jesse, you look so dashing.